Hello, and welcome to Reflections on Investing with the Cornell Capital Group. And today I'm going to talk about something new, and that something is what's called the tax timing option. And with President Biden introducing or suggesting that we have higher capital gains taxes, the tax timing option becomes even more important. Sounds real complicated, but it's really not. Here's how it works. Let me give you an example. Suppose you buy an S&P 500 exchange traded fund. In that case, you'll pay tax when you sell the fund. And that's your only choice, to buy or sell the fund. But now suppose you held the individual stocks or some of the individual stocks in the S&P 500. Let's say, for example, that you held Apple and Amazon, but you held them as individual stocks. Now suppose that Apple goes down and Amazon goes up, but the overall S&P 500 stays about the same. If you hold both Apple and Amazon, you can take advantage of the tax timing option. And the way that arises is the capital gains tax is levied when you make a transaction and you realize a gain or loss. Till then, there's no tax. So if you happen to hold both Apple and Amazon, then you have an option to continue to hold the stock that went up and avoid paying a tax, but to sell the stock that went down and realize the loss, which you then might write off to an extent against income, or if you've sold your home, against another capital gain. And that is what the tax timing option is. And what we try to do with the Cornell Capital Group is have people hold a diverse portfolio of stocks, but hold them individually, not all in funds, so that you can take advantage of this option. Now, I want to add one more thing to that. So suppose we have you holding Apple here. Suppose you buy Apple, get another color, but you write or sell Apple options. Now, in another session, I'll talk more about options. But for now, you can think of if Apple goes up, the options that you wrote or sold go up, so the value of your investment is going to go down. Now, what's the point of that? Well, the point is by holding the two, you can reduce risk. But from the perspective of the tax timing option, if Apple's up and the Apple options are down, you can choose to defer the gain and realize the loss. So that's the key to the tax timing option. It's to defer gains and realize losses. One final point. You used to be able to defer the gains indefinitely, and then when you died, the capital gains tax would be forgiven and your basis would be stepped up. President Biden, in addition to proposing to increase the capital gains tax rates, has also proposed to do away with the step up in basis at death. But even so, the tax timing option may not be quite as valuable if you lose that step up at death, but it still has meaningful value. And at the Cornell Capital Group, one thing we try to do is realize that value for our clients. So thanks for joining us, and hopefully you enjoyed learning about the tax timing option.